you for. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland. I am very happy to welcome Anthony Cammarata today to lead a workshop on startup financials. So Anthony has spent his career working with and for entrepreneurs to help them grow their companies and realize their vision. His career began in public accounting, progressed to working in private equity and venture-backed companies. He's always been a champion for the entrepreneur and understood a company's vision, goals, and obstacles, and then built an operating scalable financial solution to realize a positive outcome. Anthony is a CEO of his own startup called Startupcannon, a contract CFO and controller service to bring the knowledge gained throughout his career to emerging and growing companies so that they can too benefit from his experience, which they otherwise would not be able to. They were much further along in their life cycle. So Anthony's specialties are building scalable solutions, financial management.
Alex Wang. Join the meeting.
Accounting, strategy development and implementation, project management, contract negotiation and resolution, tax and compliance. Again, thank you so much, Anthony, for joining us today and sharing your knowledge with us. I know you have a lot to go through. Before we begin, just very quickly, if you have a question, you can submit it either through the chat function or you can at some point also be able to unmute your camera and your mic and ask your question live. Anthony specifically asked to have this session not as a webinar, but as a meeting so that it could be more interactive and you participate. So thank you so much, Anthony. And we can go ahead and begin.
All right, thanks. I guess we got a couple people in here, so I'm gonna go through the slides and then we'll have some questions. We'll have some time for Q&A because there's quite a bit here. So the purpose of this talk was to be relatively high level and basic and touch on a few different areas. So I'm just gonna so we'll just start here. The first thing that and really quick, just a disclaimer, this is not tax advice or legal advice or accounting advice, so don't sue me, if you make a bad decision based on what you heard here. Anyway, so I want to go through a few things today. The first is something I always bring up, which is how to think like Maslow. I think there's some people on the call that are kind of in the science background, so maybe that's apropos for this. And then we're going to go through the types of accounting, how to keep good records, the basic financial reports, and then when it's best to hire a professional, and then what things can you do on your own. And so the first thing is, let's think about accounting like Maslow did, right? So Maslow started with the very basics of of safety and whatnot, and eventually said, we need to achieve our potential. And the same thing goes for finance and accounting. And so at the very basic level, we need to do some things like report our taxes, right? We need basic tax and accounting, basic tax accounting. And this might not be that valuable to business, for instance, but you need to do it because, some government wants you to do it. But as we get more sophisticated, we can kind of move up this hierarchy, right? And so the next thing is that we want to move into basic GAAP accounting. This is doing actual correct accounting that gives us good understanding of the company. The next thing is reactive finance. This is when we're doing planning based on what we know in the company and based on what's happened in the past, but we're not really thinking that much into the future. The next thing is what we call strategic gap in tax accounting. And this is where we say, okay, we understand what's going on with the company and we're sophisticated and we can make decisions that positively impact the company. And so this might be how we, using rules to present something in a more favorable light. This might be taking on certain tax transactions that are beneficial to the company or the owners of the company. And at the very top is predictive finance. And predictive finance is where we are where we're thinking about the future and what decisions to make, not just on what we know about what's going on inside our company, but also what is happening outside of our company in the macroeconomic environment. You know, what are our marketing people telling us? You know, what do we know about other things that are happening in the world? And so, you know, when you first start a company, you need to decide what kind of accounting are we going to use. There's two basic types of ways of keeping accounting records. The first is called GAAP. GAAP stands for Generally Accepted Accounting Principles. And the second type is called cash accounting. And for, you know, when I talk to companies and we have to make this decision, I would say 95% of the time we use GAAP accounting, and I'll explain that in a moment. But we do have the option of using cash accounting, although it's typically not recommended. And so, what is the difference? GAAP accounting says that revenues are recorded when they are earned. It's really important, when they're earned, and expenses are recorded when they are incurred. These two words are really important. And cash accounting says that revenues are recorded when they are received and expenses are recorded when they are paid. And I'll explain this in a moment. But at the bottom, you can see that I think of GAAP accounting as the horse is leading the cart, and cash accounting is kind of like the cart leading the horse, right? So, so in GAAP accounting, we say revenues are recorded when they are earned. That means, you know, if I do work today for somebody, or you do work for, you know, for somebody today, or you deliver a product today, you know, you might get paid for it, you know, in 30 or 60 days, but you still earned it today. And so you would record that revenue that you've earned, you would record it today, and not in 60 days when you actually receive the payment. That's exactly the opposite in cash accounting. And in cash accounting, even though you did work today, you wouldn't record the revenue until you receive it in 60 days. Similarly with expenses in GAAP accounting are recorded when incurred. So if someone does work for you today, but you're not going to pay them for 60 days, you would still record that expense today, regardless of when cash is actually, you know, given to the other party. And in cash accounting, it would be the opposite, where even though you incurred the expense today, you're not going to pay it for 60 days, so you wouldn't actually record that expense until you actually pay it. And so even though this seems kind of simple, in practice, we'll get into this later, but some accounting knowledge goes a long way into understanding, you know, kind of how to do this properly. And so what kind of companies typically use GAAP accounting versus cash accounting? Typically product-based companies, like software companies that sell, you know, inventory, construction companies, things like that, typically use GAAP accounting. And service-based companies, typically accountants or consultants or attorneys, might use cash accounting. That's kind of what's typical. And for cash accounting, it's exactly flipped, right? So service-based companies typically might use cash accounting, where product-based companies typically don't use, you know, would not use cash accounting. There are many exceptions. Like I said, when companies come to me, probably 95% of the time, we use GAAP accounting and not cash accounting, and that includes even service-based companies. But it just depends on the situation and where the company's going, and where they are, and a variety of other, you know, questions. Couple major notes here. Companies that are public, companies that are traded in the public markets, have to use GAAP accounting. And also, as companies grow, eventually, you know, they probably will need to get what's called a financial audit. So a CPA firm will have to come in and audit the company, and you cannot pass an audit if you use cash accounting. That's another reason why, you know, typically we recommend GAAP accounting. The next thing we're going to talk about, so we're already on topic 2, is how to keep accurate records. So, and these are, we're talking mostly financial records here. So we need 3 things to keep good records. We need some type of accounting software. We need some way to retain our documents, and we need some knowledge. And so when it comes to software, quite frankly, the options available for most companies that don't want to spend $30,000 a year are not great. So you've probably heard of, QuickBooks. There's another program that's popular that I see a lot called Xero. There's another company out of Reston, Virginia that it's a young software company. It's a young software system, but we're still investigating it, and it looks like it has a lot of promise, called Atwork Systems. Those are what I'll call, the lower tier systems, lower tier but popular, and typically what I see a lot of. There are other lower tier solutions that I see once in a while that I would probably not recommend. One's called Wave. It's a free product. Another one's called, FreshBooks or Zoho Books. Some companies think that they can keep all their records in Excel and that they'll never have an error. I don't recommend that. And then there's a variety of lower cost other accounting systems that typically I wouldn't recommend. And that's, without getting into the details, that's pretty much because most companies will outgrow the stuff where I say lower tier, lack of features versus price. A lot of companies will outgrow what those systems can provide very, very quickly. In the mid tier, if a company is growing and has some budget, in the mid tier, we had a bunch of products that are actually fairly decent. One's called Intact, the next one's called NetSuite. There's a company called Workday, and there's a bunch of others. There's a lot in the mid tier. The thing I would say about choosing software is that the difference between a lower tier and a mid tier software and even a higher tier software is the distance between them price wise is pretty drastic. So lower tier software might cost you tens of dollars a month, where mid-tier software might cost you thousands of dollars a month, for instance. So that's a bit, some of the basic accounting software that typically we see that companies are using. A note on this lower tier software is that typically what they really are is they provide a database to do some transactions and keep some information, but they don't do everything. They really give you what's called a general ledger that kind of holds on to your transactions. But if you have to kind of make it robust, then you have to use what are called like add-ons or plugins or apps. We all have like your phone provides essentially a little computer, but you add apps to it to add more functionality. It's the same with accounting software where QuickBooks might provide the database, but you might have to use some plugins to get better automation in your company. And some examples are automating accounts payable, automating expense reporting, automating recurring billing, automating payments for credit cards or online payments, inventory accounting. I see that quite a bit, and times material accounting. The biggest one by far is accounts payable automation. And a note on these add-ons is simply that even though you might be spending not a lot of money on your base accounting software, some of the costs of these add-ons can get quite expensive, and so some of them cost more than your accounting software does. So just know that when you are budgeting for accounting software, it's not just the cost of software, it's also the cost of the add-ons that you might need. A couple more notes on using software is that instead of just jumping into software, it helps to get some knowledge first. Second is that the UI for these things have made it feel like everyone can be an accountant, and and so they make people feel really good about they make it feel like you're doing good work right away, and that's not always the case. And what this can lead to is a lot of errors and a lot of kind of transactions that are done incorrectly that someone has to fix later. So getting a little knowledge first is is well worth your time investment. When you do go to set up accounting software, the first thing you need to do is set up what's called a chart of accounts. So, if you think of accounts, it's simply just a listing of accounts. It's you're checking an account for checking, account for accounts receivable, account for accounts payable, accounts for maybe notes payable, so on and so forth. The listing of this is just called the charts of accounts. And typically when you start using some accounting software, it will say, hey, what kind of company are you? And you'll say, whatever, I'm a software company, or I'm a construction company, whatever it is. And they'll say, great, we have a chart of accounts that you can use. Do you want to use it? And you can say yes, and it will self-populate a chart of accounts. And I would highly recommend you don't do that, because typically that may work for a company that's like a mom and pop company, but it doesn't really work for companies that become more sophisticated, either today or in the future. It also leads to having a lot of unused accounts. And so when people are trying to do their own accounting, they get confused with all these unused accounts and they end up making a lot of errors. So instead, I suggest you come up with your own chart of accounts. And how to do that, and the way you do this is kind of simple. You think about, I like to say, let's think about where the company is today, and let's think about where it's going to go in the next 3 years. And outside of your accounting software, you literally write down all, I like to use Excel. You literally write down every account you think you might need in the next 3 years. And then once you've done that, you refine that list and you say, okay, out of this big list of things I'm going to need, I think in the next 3 years, what am I going to need just in the next 6 to 12 months? And only take those accounts and just add those to your accounting software. That way you don't have a bunch of accounts that may not, be used forever. It leads to less confusion. And when you do come to the point where you say, oh, I have this new type of transaction, I don't have this set up in my accounting software, you have a list to go by, where you can say, oh, well, let me go to my master chart of accounts that I've set up on Excel and figure out which account to add. And so you've already kind of done all that work in the beginning, and it actually does lead to a tremendous amount of time savings, and also savings in not being kind of confused. So chart of accounts, usually there's an account name, and usually there's an account number. And a lot of accounting software, I hate to rag on QuickBooks, but they might be one of the offenders here. Probably there's a lot of offenders, is that they may not by default set you up with account numbers. And I would highly suggest that you set up account numbers. And account numbers are literally just a number that you put next to the account, and it really does help you with organization. There are no standards as to what account numbers you should use, except that you'll see my example below. A lower number, these account types: current assets, long-term assets, current liabilities, long-term liabilities, equity, revenue, cost of goods sold, and expenses, should go from lower account number to higher account number. And so I've just given some examples below. You can certainly deviate, based on what makes the most sense for your company, but you should use account numbers. Next, I'm going to talk about document retention. I know I'm going quickly here. There's a lot of material to cover, so we'll have some time for Q&A. And also, you'll get these slides at the end. But we need to retain our records. And so the law says you need to keep your records for 7 years. Today, it's so cheap and easy to keep, to store records. You might as well just keep them forever. Even if you don't keep, your underlying records, longer than 7 years, I would always recommend that you keep your tax returns forever. So anyway, you have to keep your records. A lot of companies, when they're starting out, there are really robust, filing systems that you can buy into, but a lot of people will just use like a Box or a Dropbox or Google Drive, and just good, want to call it, document retention or security practices is that you want to make sure that that whatever you use does back up to a second location. God forbid you or an employee or someone, deletes them off the first location, you have them in the second. And I typically like to have 3 different file types in a company. The first is a, and you might set these up as folders or however you want to organize it. But first, usually I have a monthly folder. This includes things that happen, repetitively month over month. So, you have monthly bank statements. You might have, you have monthly, call them journal entry work papers. You make journal entries and have to document those every month. Certain other reconciliations that happen every month. I like to keep those in a monthly folder and simply just roll that folder every month. So at the end of the year, you'd have a separate folder for January, February, March, April, May, June, so on and so forth. Then I like to have a yearly folder for items that remain within the year, but may not continue on over a year. These are things like vendor files or company files. Sometimes tax returns. Sometimes I put tax returns in the permanent file. Just depends. And then a permanent file, and these are for things that for items that exceed a year. These are things like your company formation documents or your government's documents, or your documents where you're selling, stock or debt or whatever the case may be. So I'll keep those in what's called a permanent file. Last in this little portion of the talk is getting some knowledge. So where can we get knowledge, right? And so there's a lot of online courses that you can do. Whenever for other topics that aren't accounting related, I don't mind going to the general public to get information, but I would recommend whatever knowledge you get, make sure it does come from a somewhat an authoritative or somewhat authoritative source. So you can use online courses. You can go to what's called CPE. It's called Continuing Professional Education, and this is what CPAs use to keep up on their knowledge. And there's a lot of good content there, and it's not all aimed at professionals. So you can go get some good CPE, from that is aimed at. You can get some CPE that is aimed at more of a general user. Next is articles written by reputable sources. Typically, these are mid and smaller size CPA firms. A lot of the big CPA firms will write really good information that's aimed at CPAs, but the smaller firms typically write really good articles aimed at more of a general reader. I have intro to accounting textbooks. You can probably pick up a cheap textbook somewhere, and honestly, they're not the most exciting, but they're actually probably not the most boring either. And lastly is online training given by I have a question. Sorry, where can we go for CPE info? CPE info, you can literally Google. I have a question here. It says, where can we go for CPE info? I think she's saying CPE, continuing professional education. You can Google, accountants, CPE. Another one I really might recommend is Paychex has what's called an accountants portal, and that accountants portal will push you onto a company called Wolters Kluwer, it's called. And Wolters Kluwer charges a lot of money for their courses, but if you go through Paychex, you can get those courses for free. And you can literally get thousands and thousands of dollars of courses for free, given by pretty good instructors. Paychex did not pay me to say this, but it is a really good source. And there's a variety of others. And then lastly, there's you can get online training by software providers. That's typically aimed at more of bookkeepers and kind of how to actually use their software. It's more tactical, less less accounting quote unquote knowledge. And lastly, where not to go. There's a ton of accounting forums, and there's also knowledge sharing bases. So software companies will say, oh, do you have a question? Here's our knowledge sharing base, and the answers will be populated by individual users. And I find that there is more bad information in those in the forums and those user bases than you might be able to imagine. And so I would actually say to avoid those. And hopefully no one sues me for saying that, but you know, not a fan. There's a lot of bad information on the forums. Lastly, you know, a lot of people will spend more time figuring out what computer to buy, how to do a project at their house, what golf clubs to buy than they will in getting accounting knowledge. And I really do think that getting a little knowledge, you know, that little bit of time investment really does go a long way. And that's not just if you're doing your own accounting, that's also if you're talking to someone who else is, you know, if you hire somebody, if you hire a firm like myself or even a bookkeeping firm, whatever the case is, you know, understanding what they're doing. The way I describe it is you know, if you're building a house, you know, and someone else is building the house, you know, you don't have to have the skills of a finished carpenter, but you should at least understand where the walls go, you know. And so it's kind of the same way when it comes to accounting and finance. You know, you don't have to be an expert, but you should have a little bit of knowledge. And then also, you know, when new regulations come into place, you'll see a lot of articles when you know, good example was the Paycheck Protection Program of this last year, or when the Trump tax reform went into place. You know, every publication will go to press as fast as possible to get on top of it, and a lot of times that early press or those early articles are just sometimes have some errors, or sometimes they really haven't thought through you know, what the new proposal is or what the new regulations really are doing. And so give it about a week if you can before you start consulting online, you know, online articles. Typically the articles that come out, you know, a week or so after an announcement, you know, have better information than the ones that come out, you know, the day of an announcement. All right, we're going to talk about the 3 types of financial reports, or the 3, you know, the 3 main financial reports. They are the balance sheet, the income statement, and the statement of cash flows. And so a balance sheet is a financial statement. It shows your assets, liabilities, and equity. We'll talk about what those are. But importantly, it's at one point in time. So it's where does your company stand at one point in time. And so and the other important thing is that, you know, you may have heard this before, you know, assets plus liabilities must equal, or excuse me, assets must equal liabilities plus equity, always, full stop. And so if your assets don't equal your liabilities plus your equity, then you got a problem. So what are assets? Assets are items that have future economic value. This is things like cash, accounts receivable, fixed assets like computers or buildings or intellectual property or trademarks. Liabilities are obligations that are owed to others, things like accounts payable, notes payable, you know, deferred revenue, things like that. And equity are things that are accumulation. The equity is you know, accumulations of contributions or distributions into or out of the company that are not current revenue or expense. So these might be things like, you know, you start a company and you sell, you know, preferred stock to somebody. The amounts that you sold the preferred stock for instance, would be in the equity section of your balance sheet. So what does that balance sheet tell us? So a few things that it tells us. It tells us about company's ability to pay its future obligations. It tells us about you know, can a company actually deliver the services promises to deliver? You know, is the company big enough to actually, say a company gets a big contract, is the company actually big enough to actually, you know, execute or deliver on that contract? Does a company have enough or too much funding? So, you know, so an example here is does the company have enough cash on hand to survive, you know, long enough to execute on what it's supposed to execute on? Or if you're an investor that's trying to come into a company, or an investor that's part of a company, you know, you might say, well, how much other equities come into this company, and will I ever make money? You know, if I put money into this company, or if I have put money into this company, do I have the ability to actually make that money back, based on typically what's in the equity section of the balance sheet. The next statement is income statement. Income statement shows our revenues and our expenses over a period of time. So this is not one period of this is not one date in time like the balance sheet is. This is over a period of time, you know, 3 months or 12 months, or 1 month, whatever the case may be. And an income statement is essentially a listing of our revenue and expenses. So revenue expenses are treated, like we said in an earlier slide, a little differently depending on whether we're using GAAP accounting or cash accounting. So revenue is recorded when it's earned, and expenses are recorded when it's incurred under GAAP accounting, and revenue is recorded when received, and expenses are recorded when paid under cash accounting. And I'll let you guys look at the slides later. I'll let you read this, you know, this slide later. So the income statement provides us with a few key measures. You know, how efficient is the company? Meaning how much does it cost to produce, you know, one more widget, if you will. Typically, we look at the gross profit line for this. Sometimes we call it gross margin. How nimble is a company? Meaning how fast can it grow or reduce its variable fixed costs, and you know, and what are the fixed costs that have to be overcome for the company to be profitable. And the last statement is a statement of cash flows. Statement of cash flows might be the most, you know, hard to understand, but also most important financial statement. The way we put this, what statement of cash flows does is it literally shows the cash that comes into and out of a company over a period of time. Again, so not like the balance sheet, but more like the income statement, what happens over a period of time. The way we put this together is we start with what I've shown here is what's called the indirect method of showing a cash flow statement. There's 2 different methods, but this is the one that's most commonly used. You know, statement of cash flow starts with net income and then moves on to show changes in the balance sheet over this period of time. I'll let you read this slide. Getting into the statement of cash flows and how it's put together is you know, can be somewhat of a deep subject. But there's 3 main sections of statement of cash flow. The top is operating activities, middle is investing activities, and bottom is financing activities. Operating activities are simply all those activities that are not investing or financing activities. Investing activities show things like the purchase of property, plant, equipment, intangible assets, things of that nature. So it's things that are of what are you buying to invest in your business. This is not investment into your business, but what are the investments of the business that helps it, that is gonna help it, you know, continue doing business. And the last section is the financing activities. This is things like getting investment into the business, or borrowing, like borrowing on your credit card or notes payable, things like that. And I believe this is one of the last sections here is talking about when to hire a professional and how to, you know, what to think about when you're hiring a professional. So these are things like accountants, attorneys, technical people. The first thing I would say is that you should give them an understanding of your business. There's more times than I can tell you where people will bring in professionals and they'll say, I need these 3 things done and just go do them. And if you're bringing in professionals that are good, they can bring a lot more to the table than just, than delivering a task. And so if they can have an understanding of your business, it will actually help them, not in just doing the task, but also in helping them help you execute on the business. Another thing I've seen a lot is, and this, I actually get a lot of work this way, is someone is really unhappy with their current provider, or their current provider is, screwed something up, and so they bring me in to clean it up or fix it. And it's just that when you're going into hiring a professional, if you did have a bad experience, like some of the people that bring me in, they've had a bad experience with someone prior, don't take that feeling into hiring your next professional, because while you may have hired someone bad in the past, your next person might be phenomenal. And so you don't bring that into the relationship. Thirdly is pro bono equals no bono. You get what you pay for. A lot of times companies try to go cheap on who they pay for, and like anything else, making things too inexpensive in the short term may actually cost you a lot more money in the long term, and typically it does. And the cost of a professional is, typically they're trading time for money. So they're, the cost of that person is their time times their rate, and a higher rate does not always mean a higher bill, because a lot of times the people that charge a higher rate are able to do things smarter or faster. And so your total out-of-pocket costs a lot of times with higher priced folks is not necessarily, your total bill is a lot of times can actually be lower, but it just depends on the situation. So let's understand the landscape of some of kind of finance and accounting, and the types of people you can bring in. So at the bottom, I think of this as a pyramid. These people are not necessarily more important or less important than others, but I think of this as a pyramid, starting with bookkeeping, followed by technical accounting, followed by finance, and at the top, followed by investment banking. That's kind of like when you're ready to sell your company, or maybe if you want to do a large financial transaction, with your company, whether it's selling or taking in some, a larger investment, later in the company's life. So at the bottom was bookkeeping. Typically, that's handled by bookkeepers. Next is technical accounting. Typically, that's handled by what we call a contract controller. These are people that are great at accounting. They may not be great at finance. Next is finance, and there are there are contract, or sometimes called contract CFOs, or fractional CFOs. And typically, sometimes those people have accounting backgrounds, sometimes they have finance backgrounds, so they may or may not be good, at accounting, but typically they're very good on the finance side. And at the top is investment banking, and we typically will leave that to investment bankers. And a lot of that is quite frankly not because your contract CFO may actually be able to do a lot of the work that an investment banker may be able to do, except that SEC rules limit what someone that doesn't have an investment banking license may be able to do. And so there are some rules sometimes that keep people from stepping over certain lines. And so in our firm, we handle some of the bookkeeping, not a lot. So a lot of times we'll do stuff that either is essentially automating bookkeeping, or for companies that want other services, other finance or technical accounting services, we'll provide some bookkeeping, but we don't do standalone bookkeeping. But we do bridge the gap of technical accounting and finance really well. And so that's kind of where we fit into the landscape. Timing of bringing in professionals. So when should you bring in a professional? Typically it's good to bring in someone early, even if they're not doing a lot, just for them to give you some good guidance, maybe set you up, to give you some decent knowledge, and maybe to do some check-in. So I have an example below. This may or may not fit your company, but this is just an example of what a company's timeline might look like. So at the beginning, they might bring in someone, like myself, just to set them up, to give them some knowledge, and then just to check in on them once in a while. Say, or maybe have them do some work, and maybe we clean it, maybe we clean it up and really tighten things up, every so often. But then later on, as a company gets bigger, they need some more expertise, and so a company like mine might come in on an ongoing basis to be their ongoing, part-time, CFO or controller. But early on, a lot of times companies don't have budget, so they might handle their own, bookkeeping. Eventually, that gets to be too much for them, or their time is just better spent elsewhere, so they might bring in a bookkeeper. And then eventually they might hire a full-time accountant, and eventually they might hire a full-time CFO. So this is just an example of what timing may look like. Okay, and then I think this is one of the last sections is let's talk about what the heck is the difference between bookkeepers, contract CFOs, so on and so forth. So, big caveat is not all firms are the same. Really important caveat. So no matter who you're talking to, really dig into what they do. Dig into what are their strong suits. What are they comfortable doing? What are they comfortable not doing? So the first thing is bookkeepers. So bookkeepers typically are good at high volume tasks, high volume repetitive tasks that are somewhat not technical, and typically they're quite affordable. The cons are that a lot of them don't have accounting degrees, although some do. A lot of them have to follow, they've set up their business so they can do high volume work, which means following a set system, and that system may or may not really work with how your company functions. And I have here, sometimes this becomes a square peg, your company into a wrong hole, or into a round hole situation. The quality bookkeeping firms is all over the place. It varies incredibly dramatically. For instance, I have a project right now where a bookkeeping firm took on work from another bookkeeping firm, and the work from the prior bookkeeping firm is so bad that they brought us in to just clean things up so that they can move forward, because it's way over their pay grade. So that's a situation where their old bookkeeping firm was really not very good. Their new one is good, and so the quality is all over the place. And lastly, for bookkeepers, typically they're generalists. So if you have a kind of a basic company, they're typically pretty good at it, but they might not know how to deal with specific circumstances. Contract CFOs. I'll let you read the top here, but again, talk to each person, each firm to really understand them. The pros are that typically contract CFO will bring a lot more experience, just more than just accounting and finance, but also help you actually run your company. Typically good for both task and analysis oriented work, and typically quite fast or quite efficient. The cons are that more expensive than bookkeepers, and typically they're not geared towards high volume work. Again, varies drastically across firms, but a lot of the work we do is kind of heavy lift, low volume work. So working with instead of dealing with hundreds of companies, we're dealing with tens of companies, compared to a bookkeeping firm. And also some focus on accounting or finance, but not both. We focus on both, but some don't. Okay, what you can do on your own? You can do most of your bookkeeping on your own. It's best to get some good education up front. You can do your payroll on your own. This is assuming you hire a payroll firm, but you can do your own preparation on your own. You can do some basic tax returns on your own. I wouldn't be too afraid of doing, for instance, a sales tax return. Personal property returns in Maryland, or annual reports in Delaware. You can do that stuff your own. I wouldn't worry too much about it. Yearly, you typically have to file 1099 miscellaneous and 1099 interest forms, depending on your company. Again, not really that big a deal. I would be pretty comfortable doing those on my own, even if I didn't, have a tremendous amount of knowledge. You can learn that stuff fairly easily. Also, simple contracts, drafting simple contracts. I think it's actually a good learning opportunity to draft your own simple contracts. It doesn't mean you should execute those. You should probably have those looked at by a professional, but the actual drafting them is actually a good learning opportunity in my experience. What you should not do on your own is a major tax returns. So major federal and state tax returns, quite frankly, are best left to a professional. And when you do get a professional to do these returns, there's something called a Schedule L and a Schedule M1. And Schedule L is particularly important. If your company has under $250,000 of revenue or assets, then a tax preparer does not need to prepare Schedules L or M1. Even if they are not required to do it, I would highly suggest that they do prepare them, because they will be very valuable to any professional that you bring in, any finance person you bring in later in your company's lifetime. And bookkeeping and accounting, while you can do most of it, there are some non-routine or major journal entries that are best left to, quite frankly, someone who's done it before and knows what they're doing. All right, and that was a lot of information and not a lot of time. So there's only a few people in here. So if you guys want to unmute or there's any questions, feel free to ask any questions you might have.
Okay, Anthony, thank you for such great presentation. While we're waiting for questions in the chat, you can either raise your hand and we can unmute you and you can ask your questions. In the meantime, I would like to present a poll with a few questions, and I hope we can get your feedback. It is valuable to us, and we do look forward to your opinion to make this a better webinar. I do see people are responding to the poll. I'd like to thank you and I appreciate your feedback. I will share the results shortly.
No questions? Nothing?
Anthony, you did a great job. A lot of information.
Sorry, it was a lot. I know I kind of sped through that, but again, folks will get the slides and they can look into it deeper.
Okay, thanks each and everyone for participating in the poll. I appreciate your feedback. I don't see any questions. If you have any questions, feel free to reach out to Anthony. His contact information is on the screen. Again, thanks, Anthony. Thanks each and everyone for participating today. We do appreciate it, and you have a great rest of your day.
Yeah, and real quick, guys, if you do have any questions, please don't hesitate to reach out. I won't give you a sales pitch or anything. I am just happy to help out.
Thanks again. Bye, everyone.
All right, take care, everybody.